Hi, everyone. I'm sure people are gathering at the top of the hour, but we wanted to kick off because today is going to be a lively discussion that we're incredibly excited for. So thank you for joining. I'm Thomas Hartman Boyce, Global Head of Investment Solutions at ARK Invest, dialing in from London today. We're live today because AI is certainly one of, if not the most important themes and most discussed topics in the markets today, right now, over the last couple of months, over the last couple of years. And it is certainly a shifting landscape where clients have come to us asking us for our latest views, asking us for our research, and asking us in terms of how we think about taking these ideas from a technology lens and applying them within the investment landscape. Now, over the next 60 minutes, we will tackle some of the most topical questions that we've received head on, the scale of AI CapEx, where that CapEx is actually coming from and why that matters, how quickly AI from a technology perspective will translate into revenue and cash flow, both from the enterprise angle as well as the consumer, the global AI race, in particular the US versus China, as well as valuations relative to history, which is, of course, an important point when we translate these views to the investment markets. And of course, the goal for today will really be to help outline what metrics matter when there's so much noise on this topic. And it's also a fitting day to have this conversation because we actually just released ARK's Big Ideas 2026 research paper just an hour or so ago on today, January 21st. And for those not familiar, Big Ideas is our cornerstone research report. It's part forecast, part roadmap. And in all Big Ideas releases, we certainly do focus on forecasting and providing our views on what will happen in the near to medium term. But I'd say this Big Ideas release especially focuses on very clear framing for what's happening right now, what's real in our view, what's misunderstood, and what to watch next. And throughout the conversation today, again, as we go through the dedicated sections, we'll translate this back to an investment angle, right? Why does this matter in terms of markets, and how are we managing our portfolios around these developments? With that, I am very much pleased to welcome Frank Downing, our Director of Research covering AI at ARK. Frank leads the team responsible for our core AI work, especially as it relates to the cloud and everything tangential to the cloud, from models and forecasts to how we think about adoption, monetization, valuation, and really the different aspects that I alluded to earlier. Quick housekeeping note. We have a live closed caption ability for those dialing in from different countries internationally. So you might want to click that CC button if you wish to watch this webinar in a different language. But with that, would like to get straight into it because we have a lot to cover. And I'll turn it to Frank, the other face you see on the screen, really the man of the hour, to walk through his latest research, again, just being released today, and his latest views on the AI landscape.
Thanks, Thomas. Like you mentioned, I'm extremely excited to be here today and present some of our latest research and kind of help frame what's happening on the technology side in the context of the markets today. And like you mentioned, this is a topic that we get the most questions on related to our research and our investment strategies. And is very timely as we just launched our annual Big Ideas report within the last hour. So it's a great day for this, and the topic and the content is all very fresh. We're going to cover some highlights from the Big Ideas report that relate to AI, starting with infrastructure and then moving up the stack through the kind of end use cases, both on the consumer side and for business workflows. And there's a ton of content if you go look at the entire Big Ideas deck related to robotics and all the other innovation platforms that we cover in our research. So with that said, let's get right into it. I think the title of this conversation is addressing AI bubble concerns, and I think when you're thinking about this, two of the questions that we ask are: is there demand, and is the demand real? And we think almost unequivocally the answer to that is yes. There is very strong demand for AI driven by one, the advent of generative models that you can communicate with natural language rather than having to be a professional AI software developer. That dramatically increase both the people that can engage with AI and the amount you can accomplish with AI. And the cost of that technology has been coming down dramatically. So this is something that's really important in our research process, which is looking at how the costs of a technology are changing over time. And when we see strong and consistent cost declines, it's an indicator that a technology is nearing or ready for prime time. And that cost decline is able to unlock additional demand and additional use cases. So this is a technique we've used in the past on other innovation platforms that we cover. For example, in the energy storage space, we looked at the cost declines of electric batteries to understand that electric vehicles would not only become possible, but profitable at scale, which led a lot of our early investing at the firm's inception in companies like Tesla, for example. And we're seeing that dynamic play out again here in the age of AI, with costs falling some of the quickest we've ever seen. So, for example, depending on which benchmark you're looking at in the AI space, costs have fallen in some cases 99% per year. So that's if you're looking at a model that can achieve a certain level of task difficulty today versus its cost a year ago. In some cases, it costs 100 times more. So these are, there were conversations in the last, in the first year or two since ChatGPT launched when Microsoft launched GitHub Copilot, their coding assistant. And the news articles were saying Microsoft is losing money on this. It's a $30 subscription, and they have some people, costing $100 a month. With these cost declines, you have these products that look unprofitable today that are very quickly becoming profitable, and we believe that product, for example, is profitable, as are the similar products from many companies innovating in the private space that we'll talk about in a little bit. The methodology we use to assess these cost declines most often is called Wright's Law. This is a derivative of Moore's Law, or a cousin to Moore's Law. And whereas Moore's Law is a function of time, that the cost of semiconductors would fall in half every 2 years, Wright's Law is a function of cumulative units produced. So for every cumulative doubling in unit production, how quickly are costs coming down? We think this is more representative of a learning rate, where the more you manufacture something, the better you get at it, and you can produce it for a lower cost. We've used that again. That was for our electric battery research, and we've applied it to AI as well. The 99% cost decline is for inference. On the training side, we've seen costs falling 75% per year. So if you think about that, that's cost falling by three quarters a year. So after a year, your training cost is 25% what it was last year. That's falling in half every 6 months. It's roughly relative to Moore's Law, which is falling in half every 2 years. So we're going much faster than Moore's Law here, which is why I think the pace of innovation feels so fast, really since the launch of ChatGPT in 2022. What is all this doing? As we would expect, it's increasing demand for AI. And looking at one measure, tokens inferenced on OpenRouter, which is a website and an API service that allows developers to easily use and switch AI models. Token consumption on that platform has increased 25-fold since December of 2024. And I think, this is a small subset of the market, but if you kind of think of an analogy or a heuristic here, tokens, we believe, represent digital intelligence. And each token is getting smarter generation on generation, and the cost is coming down relative to the intelligence delivered. So even though we've seen this explosive growth over the last 3 years, knowing that this product evolution and this technology evolution is continuing and being consistent, and that we're just at the beginning of integrating a lot of this technology into business workflows, for example, really is promising for the long-term demand outlook. So with that preamble, if we go to the next slide, putting some additional context into what investment is happening right now. And AI requires accelerated computing powered by GPUs or custom application-specific chips, or commonly called ASICs, and can't be run efficiently on CPUs. And if you look the last 10 years prior to the launch of ChatGPT, the global data center system investment, so this is compute servers, networking, and storage that goes into data centers, that was in a range of roughly 150 to 200 billion dollars over that 10-year period, growing at about 5% per year. And now with the growth in AI, we've seen an acceleration to 29% over the last 3 or 4 years, reaching just short of 500 billion in 2025. Gartner, which provides this data, is estimating 580 billion, so continued accelerated growth relative to the long-term trend into 2026. And historically, their 1 year forecast has been very conservative relative to the actuals. So I wouldn't be surprised if we see 600 billion or north of data center system spending in 2026. Now, if we go to the next slide, I think it's important to put this in context. We're spending a lot on AI, and if you look, comparing to the last time we were spending a lot on, let's say, foundational computing infrastructure, the tech and telecom bubble of the late 90s and early 2000s, we see that we've reached similar levels of spending relative to the size of the economy. This is using S&P 500 IT and comm services sector capex as a percent of GDP, where now in 2025 we're hitting this 0.5% of GDP on annual spending. And I think if the forecasts are right for next year, we might see this break out to a new all-time high. So, if it feels like these numbers are big, it's true, they are quite big, and we haven't seen the spending in a quarter of a century. And I think what's interesting, if you look at this historic chart on the left side, that percent of GDP bottomed both post .com and post Great Financial Crisis, and is from '08 to 2010, and has been steadily increasing since then. And when you think about this in context, it actually makes sense that this has been consistently increasing as technology has become such a larger component of our day-to-day lives, where you would expect these tech companies that are now the largest and most profitable companies in the world are representing a large part of spending. And so while we are seeing likely what's going to be new highs in these numbers, it does make sense relative to the role that technology plays in powering the global economy. So if we go to the right side now, I think it's important to think of where is the market in terms of speculation and valuations. And if we look at the Mag 6 companies as representative of big tech today and compare them to big tech in that late 90s era, Cisco, Oracle, Intel, Microsoft, for example, we see the multiples of today, which the PE multiple is just below 40 for the Mag 6 today. That's about 1997 multiples compared to big tech in the 90s. And where did that go? Multiples went all the way up and peaked over 100. So for a lot of the market headlines that are claiming for AI bubbles and that there's elevated valuations, we really see like that we're far from where things got to in 99 and 2000, despite the headlines. If you zoom out and want to look at the broader market, which I think is helpful to give perspective as well, the S&P 500 PE multiple bottomed around 20 in COVID in 2022 and is now about 30. So it's gone up about 50%, which is a significant rise, but I would say off of an overly pessimistic base. It was quite literally at the bottom of the market. And if you look at S&P 500 PE multiples, in the .com era, it peaked just after 2001 at 45. So the market multiple is still sub-peak as well. Part of the reason why multiples, I think, look better on average, or at least earlier in the cycle than past cycles, is because of the inherent profitability of these companies and their businesses, where the large cloud providers, for example, Amazon, Microsoft, Google, more and more of their business is now composed of infrastructure as a service and platform as a service offerings. AWS now makes up over 60% of Amazon's operating income, for example. And that's a direct beneficiary of the demand for AI, where they're growing that business at 35% operating margins. So they have both strong growth at a very large scale and profitable growth. So if we go to the next slide here, um, the this is our representation of the forecast of where we think this is going. Now that we've kind of put this in context of where we are relative to past cycles, and a bit of what's driving the demand, which we'll talk more about later on, but. We think that this roughly 500 billion of data center system spending in 2025 could nearly triple by 2030, growing sustainably at a 30% annual rate to 1.4 trillion by 2030. So that roughly 29% growth rate we've seen since the launch of ChatGPT, we think is possible to continue. And how we kind of come to this modeling, and how do we get to this 1.4 trillion in system spending? We look at system spending relative to software revenue, which was in the actual 50s in the build out of the cloud. So, for every dollar of software revenue, there was 50% of systems investment supporting it. That bottomed during COVID as kind of the cloud scaled and actually got overbuilt. It bottomed at 20%. We think the software market could grow as you add in new AI products and services to 7 trillion by the end of the decade. And if you just take that bottom of the market, that 20% of investment relative to revenue, that's where we get to 1.4 trillion in spending. And the composition of this market, a majority of it is being spent on compute, which makes sense. That's the AI workloads require compute. That's what's driving the growth. And there's a shift from traditional CPU-based computing to accelerated computing, which you can see on the right-hand chart here, as I alluded to earlier. And whereas NVIDIA has, been first to market and dominated market share in the beginning of this wave, we think future growth will be driven by one, new competitors in the GPU space, namely AMD, which is coming to market with a competitive product and has, been very successful at competing in the past, both against NVIDIA in the consumer market and against Intel in server CPUs, where they've consistently gained share. They're at about 40% market share in server CPUs, starting from a base of about zero in 2017. So it's just been really consistent on execution. That gives us strong confidence they'll be able to do the same in the AI space. And we see good indications of that, or leading indicators, where they've signed notable customer wins ranging from OpenAI to Meta, Microsoft, and Oracle, for example, that we think paint a strong picture for share gains there. And then I mentioned application-specific chips, or ASICs. This is basically custom silicon designed by companies building chips for their specific workload, where they can design exactly the configuration of the chip to best match their needs. Tesla is famous for doing this in their cars, actually. And the most famous custom silicon project in the AI data center space is Google's TPU, where they really are notable for having a vertically integrated stack where they make their own chip, or I should say they design their own chip. They have their own cloud, and then they have their own consumer AI applications and models that run on top of that infrastructure. Notably, Google, and that's why I caveated that statement, they design the chip. They work with back-end partners for part of the design and the manufacturing, which would be most notably Broadcom and TSMC. So in the custom silicon space, a lot of times a hyperscaler, which basically means internet scale company, will design the logic of the chip, exactly what functionality they want it to have and how they want it to behave. And then they'll work with a partner like Broadcom, which actually translates those design intentions into silicon, and then works with a manufacturer like TSMC to actually build the chip. And TSMC really is powering basically all new AI chips at the moment, because Intel's foundry has really fallen behind and disappointed expectations. So that's the lay of the land for infrastructure. Now we want to transition to talk about the two of the end markets for AI. One is the consumer. The second is business. There's an entirely third, very large category, which would be embodied or physical AI that maybe we'll touch on, but can cover in another webinar as well. And on the consumer side, we view generative AI and these AI agents or personal assistant applications like ChatGPT, like Google's Gemini, really as a new consumer operating system. And you can think of it as a new point of control on the internet. This is the new first stop for many people, and is growing share at the margin. Rather than going straight to Google search, I find myself, and I'm sure many on this call do as well, going to ChatGPT, going to Gemini, going to these other apps, to answer questions, and then also, increasingly to accomplish tasks. I think that's a shift that's just happening now. Agent was a huge buzzword in 2025, and when I think of what that word means, because it does get used in many contexts, you're giving the model agency to do something for you. It's not necessarily just a back and forth question and answer, but I want you to go out of the context of just this chat window and go do something. And a good example of that is something that's recently launched from OpenAI called ChatGPT Apps, where OpenAI is now opening up ChatGPT for developers who can build apps that are embedded directly into the ChatGPT user experience. So Instacart is a grocery delivery company that has built an early app here, and the vision, and I've tested this, is that you can be browsing a recipe book, take a picture of the recipe, and tell ChatGPT, go order all these groceries for me, and they show up at your door. It works about 80% right now. It takes a picture, it understands all the groceries, it loads up your cart, and then you review it and switch a few things if you want organic chicken instead of basic chicken, or it got some things wrong. But did it save me time relative to going to the grocery store or typing things into Instacart myself? Absolutely. So I've been impressed by that kind of early framework for allowing a experience to have not a new app on your phone, but a plugin inside of GPT that you and the model can work on together instead of you having to do everything yourself. And it's this kind of like composable, extendable, action-oriented capability that I think is going to drive the next wave of growth in generative AI on the consumer side. And you can see, and everybody can feel this, the adoption has been much quicker than the adoption of the internet. So we looked at AI chatbot penetration as a percentage of smartphone users, which you can think of as the TAM for consumer AI. A majority of time spent does happen on the smartphone apps, relative to internet penetration of PC users, where we've reached almost 20% of the population in just 3 years since the launch of ChatGPT, whereas that took 7 years in the internet. So it feels like both on the cost decline side, as I mentioned earlier, for kind of foundational technology, and on the usage and adoption statistics, that things really are happening much faster than the age of the internet. And that's part of the reason and the support for all of this infrastructure investment that's happening right now. And if we go to the next slide, I think it's important to double click on where the monetization is coming from. A majority of consumer AI, nearly all of it, has been monetized through subscriptions. These $20, in some cases $200 premium tiers, which I think is really business users or power user hobbyists more so than the everyday consumer. But it's been a subscription base. We think a transition that's going to happen in 2026 and continue through 2030 is indirect monetization that's driven by two key drivers. So in addition to subscriptions, you will have take rates on commerce. So that Instacart example that I gave, you can easily see OpenAI taking a referral fee on that transaction. Similar to any sort of shopping experience that gets built out in these AI apps, you'll have a take rate on the commerce that occurs there. Our consumer internet team, which is led by Nick Gruss, believes that we could see 25% of global online spend driven by or facilitated by AI by 2030. That would be about $8 trillion of commerce. The second form of monetization, of indirect monetization, is advertising. And we're just seeing that now be announced. OpenAI, at the end of last week, announced that they will be testing ads for the first time in ChatGPT. This will allow them to scale their free user base quite a bit more. And if you think of OpenAI's economics, their percentage of total users, which they're at 800 million plus weekly active users. Sarah Fryer just announced they're at a new all-time high, so it's probably 900 million plus. They only subscribe or convert about 5% of those to paying users, which means they're losing money on the other 95%. Once you add advertising into that experience, you can start to monetize a much broader and a much deeper customer base. They're targeting to make about $2 per user this year and ramp that up to $15 by 2030 through advertising. That's compared to Meta, which is best in class at 50. So there's kind of ample room to grow when you get to kind of the mature stage of AI driven advertising. In total, the consumer team believes that we'll see an 800 to $900 billion market by 2030, made up actually mostly of indirect monetization from um, ads and commerce, with a healthy dose of subscriptions continuing to grow as well for the users that want either an ad-free experience, or want greater capabilities or greater compute allotments.
And Frank,
So transition.
yeah,
Yeah,
and
go ahead.
Frank, sorry, I was going to jump in with one point that helps paint the picture. To your point, lots of upside in terms of how these companies will monetize, but we're still not necessarily at a low base in terms of revenue itself. So if you look at revenue for OpenAI, for example, was it about 2 billion just about 2 years ago? And I think we're significantly higher than that. I think they just, Frank, you know the exact figure. I think they came in at 20 billion end of year, last month. And then Anthropic last year alone, they went from about 1 billion to 9 billion. So close to a 10x in revenue in 1 year. So again, while there's lots of upside, the revenue is already being seen today. So just wanted to add that one point.
Yeah, great point. And very important when people are asking, we see the investment, we get why, but where is the actual revenue coming from? Which we'll dive into actually a little bit more in a few slides as well. Which actually I think that's a great jumping point to shift from the consumer over to the enterprise, and talk about what we're seeing for AI accelerating work and knowledge worker productivity. And I mentioned a few benchmarks and cost declines earlier, and I think it's really easy if you're spending all day in this like I am to get lost in all these different benchmarks. A lot of them are losing value. What is 72% versus 75% on PhD math questions? It's hard to interpret that. One that I think is actually quite representative and still generally useful is something called the meter study. So they look at a basket of tasks from a wide range of job functions, and they've estimated how long it would take humans to accomplish those tasks. And then they look at how capable AIs are at actually doing each of those tasks at various different success rates. And what we've seen is exponential and actually super exponential growth so far on their ability to accomplish longer duration tasks. So during 2025, models went from being able to accomplish 6-minute tasks to 31-minute tasks at an 80% success rate. So it's a 5x growth in 1 year, and 6 minutes doesn't sound impressive, but all of a sudden 30 minutes now is more representative of a good chunk of your workday. And like I said, super exponential means it's actually bending the curve of this exponential trend line that we've plotted on the graph, and growing faster than that. The other framing they have in their study is 50% success rate. So can accomplish this half the time, not as reliably. And whereas on the 80% success rate, OpenAI has the best performing model at the top there. Claude 4.5 Opus from Anthropic has the best performing model on that lower threshold of success rate. And that is accomplishing tasks ranging up to 4.5 hours. So if you are on X or even just looking at tech news recently, you may have seen over the holidays Claude Code, which is a coding application from OpenAI, from Anthropic, has blown up and gone viral as people are realizing that this new model, Opus 4.5, combined with a coding tool that has access to your file system and the internet, can one, automate a significant chunk of software development, and then two, accomplish everyday tasks for you at much higher capability levels. I think another benchmark, if I was going to give one that is emblematic of this, is a software engineering benchmark that if you go back 2 years, the best models could solve about 5% of the problems in that benchmark at the start of 2024. And by the end of last year, that Opus model from Anthropic was the best performing and could solve 80%. And so outside of getting a better test score, what does this mean in practice? I used to be a software developer before coming to ARK, so I feel this on a deep level. At 5% success rate, you don't even want to try it. It's like it's going to be a waste of time. It's a cool trick. It makes a good demo, but what is this going to change for my day-to-day work if it can't do 19 out of 20 problems that I'm trying to have it do? At 80%, where it works 4 out of 5 times, you're kind of saying I'd be stupid not to try this. And I think that's why you're seeing with just the capability level crossed in the last 6 months, why it's igniting one, so much buzz, two, driving revenue for these companies. We'll look at Anthropic in more detail on the next slide in a second, and incentivizing more and more data center investment. On the right side of the chart here, you can see some just simple napkin math for what it takes to break even on a ChatGPT subscription. OpenAI published a study towards the end of last year that shows that knowledge workers are saving on average 50 minutes a day from ChatGPT. The median salary in the US is $56. So that value of time savings is about almost $50 a day relative to a $20 a month subscription. So if you're not subscribing to these tools, I think you should be, because they're literally paying themselves back in about half a day of use, which you might ask yourself, which I think this is a fair point. I don't feel like I'm working an hour less a day. I'm working the same. That's productivity at work, where we might be working the same, but we're producing more and we're getting more done than we would have in the same amount of time than previously. So if we go to the next slide, I actually think before we get into Anthropic, we spent some time in our research this year looking at what's going on in China, particularly because, and maybe the global landscape generally, but a large focus of it has been on China. Because this time last year is when the DeepSeek models came out. The market had a total freak out. All the compute companies sold off quite a bit because DeepSeek had a paper where they trained a model with a much lower compute budget than was previously done. And I think, in full context and hindsight now, the surprise wasn't, and this is what we thought in the moment as well, honestly, but the surprise wasn't that there was a cost decline. I talked about right at the beginning that cost declines are extremely strong, and we'd be surprised if there wasn't a 10x cost decline for some component of the AI stack in a year. It was more so surprising that it came from China. So if you look at the launch of GPT-4, which was really the first generally capable AI model that powered really the second version of ChatGPT, which came out at the beginning of 2023. China didn't catch up to that for almost 2 years. And DeepSeek is when they really closed the gap. And different industry estimates out there put about 50% of the world's AI researchers in China. So we really shouldn't be surprised that there's good research coming out of China and they're able to create good models. I think the question is, how will they be able to keep up and scale given the compute limitations placed on them? So what's happened since 2024? China has consistently been about 6 months behind the US. And if you think of the pace of change being 6 months versus 2 years in AI time versus Moore's Law time, it feels more like they're 2 months behind or 2 years behind in actual capability. There's a reason why Claude Opus is blowing up and people aren't talking as much about accomplishing the same quality of tasks on the Chinese models. And then the second is that they're compute limited. So the US and the US allies have limited the sale of both high-end chips and high-end manufacturing into the China market, so that China doesn't really have access to any compute infrastructure that is better than 7 nanometers, which is a over 6-year-old technology at this point. We're down to 2 nanometers and below. And so it's been a huge priority for the CCP to develop in-house capability. They're incentivizing their companies. They're blocking imports of NVIDIA and AMD GPUs. This has flipped back and forth so many times. It's clearly a global bargaining chip because of its strategic importance outside of just the AI space. So we expect continued kind of volatility there. If they get turned on, it's a significant tailwind for the US-based chip designers. But it could go either way with today's geopolitics. How well can China build internally? They don't have access to better than 7 nanometer manufacturing technology. And that takes, ASML is the dominant player there and they've had a monopoly for a long time. It might take a decade plus to catch up on that front. So it will take time. And then even outside of that, purely on what they can manufacture at the 7 nanometer level, our analyst, Joseph Soya, did a comparison of TSMC's manufacturing volume per day relative to SMIC, which is the leader in the China market. And TSMC produces 38 times more chips or more transistors. So there really is a scale disadvantage here. And that's why, despite the geopolitical concerns, why AI chips going into China would be such a valuable asset for them, and why they're both using this as a negotiating leverage between the two countries. There are national champions on the AI model space outside of the US and China, like Mistral in France, for example, but we don't see them topping the leaderboards in these benchmarks, which is why they're not represented here. They've, I think, all kind of focused on specific niches, which would be, building custom models for a local market that has a language advantage or something more nuanced than, what some of these general benchmarks would suggest. So I've previewed it a few times, but now we'll talk about where the revenue is coming from, which, if you're only looking at the public markets, on the next slide here, you'll see a lot of the innovation is happening in the private markets. So you can't be blamed for missing it. And you feel that if you look at the performance of software stocks. The Wisdom Tree Emerging Cloud ETF, which I think is a good representative of software as a service companies, was down about 10% in 2025 relative to the S&P being up 17%. So really significant underperformance in the software space. And I think that's driven by some of these things like AI lowering the cost to develop software. There's real questions about what the durability of the moat of some of these large traditional software application companies is going to be. And that's not to say that there won't be growth in the software space. We've looked at relative, a study on historic growth rates and seen that platforms as a service companies, these are companies building tools for developers, data platforms, automation tools, coding tools, observability. All of those companies have been growing at a significantly faster rate and actually taking share from SaaS applications over the last 5 years. And we think AI only accelerates that trend. And that's probably why you're seeing this underperformance in, especially application software companies. And the second is that their business model inherently is less aligned to the unit economics of AI. If you're a seat-based pricing model and AI is primarily priced on a usage basis, and AI may require a slower growth in seats. I'll touch on employment on the next slide, but might require a slower growth of seats than in the traditional market. That's a difficult setup for a lot of companies. So where is the trend being bucked in the software space? It's in the private markets where, as Thomas said, we've seen over 10x growth in OpenAI's revenue from 23 to 25, now topping $20 billion. And Anthropic, and I mentioned some of this with the virality of Claude Code, has been growing at an even faster rate, 850% compound annual rate over the last 2 years. And to put this in perspective, this makes these two private companies some of the largest companies in the public software space. There's been much to do, and we think very rightly deserved, about Palantir in the public markets, one of the best performing public software companies. And Anthropic went from $1 billion in annual run rate revenue at the end of 2024, relative to Palantir's $4 to $5 billion. So they're about a fifth the size of Palantir, to $9 billion in 1 year. So they went from a fifth the size to double Palantir, almost double in 1 year, which is just pretty remarkable when you think about it in that context. That some of these AI labs are now, challenging and becoming bigger than some of the best performing public software companies. And I would categorize OpenAI and Anthropic, these model builders, as horizontal productivity providers. They're building the actual models and training them, and then building the products that can be applied across many different domains. And they're doing that more so than specializing. Anthropic has specialized more than OpenAI, particularly on the AI coding side, and then also going into financial services and healthcare as well. But we think there's ample room for specialized startups in this space that will take one of the horizontal companies' general models and apply their own domain expertise and potentially data to take those models even farther and help companies hold their hand more of actually implementing that tool in their business and their workflows. So we look at across the different domains, software development, legal, healthcare, customer service. Companies like Sierra and Harvey are 2 or 3 years old and have 100 million in run rate revenue. And Cursor, I've talked about the software development progress. It is definitely the standout. A 3-year-old company that has 1 billion in run rate revenue. To give you a sense of this compared to the cloud software era, reaching 100 million in ARR in a relatively quick time period, like 4 to 5 years, was really rare. So companies like Twilio and Zoom, for example, both reached that in about 4 to 5 years. And if you looked at their employee base when they hit that level, Twilio hit 100 million ARR with about 500 employees, Zoom with about 400 to 500. These AI startups are hitting these levels with much smaller employee bases, meaning they're not just monetizing it, but they're doing it much more productively. So Cursor, for example, has 250 employees. So if you think about that, half the size of Twilio at 10x the revenue. It is just really incredible. And I think these are, examples in the public markets because these are startups that are fast, nimble, founder-led, really embracing innovation and starting from a blank sheet of paper. I think these benefits will trickle up to public software companies, but it will take some time. And the ones that do not adapt are ripe for disruption. Which, as we'll get into in a bit, Thomas, is why active management is an important overlay in this space. So let's now zoom out to the broader market and our forecast for AI software and services generally. There's about 1.4 trillion in global annual software and cloud computing spend today. We think that AI will accelerate the productivity of knowledge workers and that the AI model builders and application builders will capture about 10% of the value created. And think that will, in the most modest case, accelerate global software revenue to grow at a 19% annual rate to 3.5 trillion by 2030. And we think there's upside of 7 to 13 trillion by that time. A common question, actually, to put that 7 trillion in context, a 37% annual growth rate, that's about the fastest that software spending grew during COVID. So it's not that this number is impossible. It's that this number would be, when we rushed to invest in software because we had it all go digital, it would be that continuing for the next 5 years. I think that's a helpful framing. And we get asked, and maybe I'll leave this for the Q&A, but we get asked about what this means for the employment picture frequently. And rather than, so I'll go in more detail later, but rather than forecasting significant unemployment, we think new technology is inherently a job creator. And that rather than seeing 20% unemployment, we are more likely to see a reduction in working hours and an increase in productivity offsetting that. Where you can see a picture with the same or more jobs in the future, with more growth offset by investment in this productivity software. So we think it's a very bright picture, and all this research gives us just more and more conviction that we're very early in AI super cycle.
Well, thank you, Frank. One thing I'll tag on as I was thinking through some of your earlier comments is on CapEx. And Frank, I know we were having a discussion last month about CapEx, I believe, as a percentage of cash flow from operations. And where it stands today, it's maybe in the 40 to 50% range. And part of the reason why it's that low relative to how big CapEx is because these hyperscalers that are driving that CapEx are very large cash flow generative companies. And in the tech and telecom boom and bust, as you use that as a comparison, which was fantastic, I think it was closer to the 70 to 80% range. So again, the sourcing of that CapEx is also important. So I thought I'd tag that on. With that as a segue, we have about 15 minutes to go through how we translate this, again, from a technology perspective to an investment perspective. And Frank, I know you were mentioning a lot of individual companies in there, as well as our thoughts around software, which is very kind of helpful as you tee up that conversation. I won't spend a lot of time talking about our investment process itself. We've done that on prior webinars, and we certainly will continue to do so in future webinars. But I just wanted to remind our clients that when we think about the names both in the public space as well as in the private space, because we have offerings on both sides, we value these names not just from a top-down perspective in terms of the technologies that Frank discussed today, but also certainly from a bottom-up lens. And we use the six metrics that you see on the page here, the top four being a bit more qualitative in nature, ranking them 1 through 10 and having a mechanism by which we adjust and recalibrate our conviction with these names on a daily basis as the markets evolve, as the technologies evolve. And then the two metrics that you see in green are a bit more quantitative in nature, one of which, of course, like you mentioned, Frank, is looking very closely at valuation as well as thesis risk, really risks that are outside of the control of individual companies, whether it's something like geopolitical risk. And obviously, we alluded to that in a number of ways today, as well as other areas. So again, I said it would be quick, but before changing the page, Frank, any names that you want to use to, very quickly highlight this framework in terms of thinking, and again, going back to AI-oriented names?
Yeah, I think Palantir is a good example. This is a company we followed since they IPO'd, and if you go back maybe three plus years ago, we saw them struggling on several fronts. On the government side, they had grown to be such a large software provider for the government that they were actually getting boxed out of new contracts because the government was worried about being too dependent on kind of a sole source provider. And then on the commercial side, they were scaling the technology they built for the government and trying to sell it into the commercial markets. They have this amazing data platform that's really distinct and unique, and allows businesses to better leverage their data in action-oriented workflows. But it's a new paradigm. And businesses, CIOs, CTOs were just not understanding why it was worth making this big switch. So they were having a tough time with go-to-market. We gave them a relatively low execution score and highlighted the thesis risk on this kind of government issue. And what we saw in the months that followed, again, this timing about 3 years ago, is that generative AI had come on the scene, and all of a sudden it created this amazing value proposition for their data platform, and they executed incredibly well in building out a AI product, which they call AIP, or their AI platform, that instantly turned their go-to-market issue around, where now they probably have more inbound demand than they can actually fulfill, which was, if you want to make AI useful and actionable in your organization, you need an action-oriented data platform, which is exactly what Palantir Foundry was. At the same time, they mitigated their government risk by launching something called Government Web Services, which is interesting, but in the sake of time, I won't go into. We increased our scores, we increased exposure across the funds, and that ended up being a course of good move, as it was one of the most best performing software stocks over the last 2 years, as I mentioned. To just end, we are valuation sensitive, and we know that while Palantir is in a league of its own, it is also the highest priced software stock by a wide margin. So we have actively trimmed and taken profits in our strategies along its rise up during this period.
Perfect. And on the next slide, I'll use this as the backdrop just to say, this is in terms of how these ideas and thus stocks translate to our portfolios. It's not just Frank, sitting by himself making these decisions. Frank is working hands-on with the investment team as well as Kathy, the associate portfolio managers, the risk manager at ARK to formulate these portfolios. And again, you mentioned it, Frank, right? Being active is crucial here. There's many developments that happen, whether it's earnings coming out or something more from a tech-related development, where we need to manage those portfolios actively by adjusting exposures, recalibrating, et cetera. So applying active management in this time where you're going through a monumental shift in terms of AI adoption is obviously, in our view, crucial. And the way we manage the funds and the results on performance articulate that, and we'll go through that momentarily. I wanted to use this slide before we move over to portfolios momentarily to help contextualize just with one kind of simple depiction in terms of how we're thinking about value and where value will accrue from an investment lens across what we're calling the AI value chain or the tech stack. And again, this is a relatively simple depiction with just a few names that we've picked out as potential areas for discussion, in particular, areas where over the last year or so, we've kind of taken action from a portfolio lens. So on the left, it's more on the hardware side, and then we transition kind of in the middle towards infrastructure, AI platforms, over to what Frank called correctly so embodied AI, right? So the application of AI in the physical realm. And just like you mentioned, Frank, if you look at our portfolios, we've been to a certain degree underweight, more kind of traditional software as a service, leaning more heavily into those highly disruptive AI platforms. So, Frank, I'll turn the mic to you. Anything you'd highlight again, more so in terms of actions we've taken as we've managed across this AI value chain?
Yeah, I've hit on a lot of these companies already, so I won't dive too deep. But I'll maybe tell a story of a few companies through one example of the research process, which is and also why it's important to follow the private markets. But looking at the success of Anthropic, that 850% compound annual growth rate over the last 2 years, they require a lot of compute, both on the training and the inference side. And we think their prospects are quite strong to continue growing with what we've seen from their latest models. And Amazon actually has a preferred deal with Anthropic, where they are their preferred training partner. So seeing Anthropic's growth, that's a leading indicator for demand for AWS and Amazon's kind of cloud services. Also, I mentioned some of the things earlier with their AWS now being a majority of their operating income. So we think Amazon is really well positioned for an acceleration in this AWS segment, and we rank it kind of the highest in terms of the big clouds that we invested in the portfolios. And then we look at who's actually providing the foundational chips for AMD. And they're actually expected to be one of the largest buyers of Google's TPU next year, which directly benefits Broadcom, which is actually the back-end design partner for Google's TPU. So Anthropic's been distinct in the AI space by looking across, from early days, a variety of compute platforms, both Amazon's custom Trainium chip and Google's TPU, to lower their cost per token, which will be and has been a tailwind for companies like Broadcom, for example, which we actually recently added to our strategy after seeing this growth that's happening from Anthropic and the broadening out for TPU demand outside of Google's in-house workloads. And then lastly, I'll call out CoreWeave, which I think is a good example of active management in that we see this strong long-term demand picture for AI, and yet we see the market kind of having rolling waves of AI bubble concerns, and CoreWeave and Oracle really getting singled out as two companies investing extremely heavily. CoreWeave on the smaller startup side with less legacy baggage is why we're interested in it. But also, the market is shorting it, thinking this is my way to hedge my AI exposure. We lean into that as the stock has sold off over the last 6 months. We've increased our exposure because we believe in their way they're forecasting their demand picture, delivering on their timelines, and we think that long-term demand is very intact. So we're averaging down as the valuation has become more and more attractive.
Perfect. And I'm sure we'll cover a few more names as we go through. But if I were to tie a bow around some of your comments from this section and the prior section, I'd say that demand will certainly continue through 2026. I'd say, again, comparing to prior periods of tech performance in the late 90s, right? A big difference with today is that there's kind of scarcity in terms of GPU, right? There's very much high demand that will continue through. And I think a lot of the exhibits and forecasts you showed have already articulated that, so I won't expand upon it. Monetization, you already talked about that in depth. So again, I think a lot of folks are eyeing this. The monetization is already real, but again, the upside is certainly quite large, and we're excited to monitor this both from the consumer lens and the enterprise lens. And then we sort of alluded to it, but the M&A market is also, in our view, going into 2026, going to really light up. And you've already seen that to a certain degree. There's lots of high-profile potential IPOs coming this year. I think that will lead to price discovery, and again, both on the private side and the public side, lead to opportunities for investment. with that, I'm going to turn this over to look at the portfolios here in the UK and Europe a little bit more closely in terms of our UCITS offering for the last few minutes. And again, one of my goals will be to show you some of the attribution in terms of how we've managed the portfolio, how sources of return aren't just coming from the mega cap names or aren't just coming from a particular category within the AI value chain. Um, just as a reminder, these are the four active ETFs we have live here in UK and Europe. The newest being our Space and Defense Innovation Fund. And you can see AI is certainly a component of that fund. But today I'll focus a little bit more closely to give you an example on our AI and robotics strategy. It invests most freely across the AI value chain that we've discussed. And I'll briefly show you some of the positioning for our flagship strategy, ARK Innovation, which is on the leftmost side of this page. An important point to make here is that despite these strategies being new to Europe, in particular ARKI, so AI and robotics being a new strategy itself, we have AI-oriented strategies in the US and in other areas that we've been managing for quite some time, where we have 10 plus year track records and about 6.3 billion in those AI and or robotics oriented strategies. So that's just a short winded way of saying this isn't our first rodeo in the space, and we've been researching these trends and these themes and these technologies before they became the topic of the day. Quickly, like I said, I won't spend a lot of time on this slide, but this showcases our innovation ETF, ARKK, and you can see, some of the names that we're talking about, whether it's AMD or others, they are certainly being captured in this portfolio. Again, we certainly are providing our clients to exposure to all of the exciting areas that Frank is speaking to and has spoken to in our flagship fund. And you can see, for example, one of the top areas of technology exposure is within next-gen cloud on the right side of the page. But again, this isn't simply a large or a mega cap or a hyperscaler story. We're investing again across both sectors, regions, and importantly, market caps. And you get exposure through that manner with, again, very high active share relative to indices. And the same is certainly true for our AI and robotics strategy. So you can see a larger allocation to mega cap at 50-ish%, if you're defining mega cap as greater than 100 billion, but very much focused on, as the name would tell you, right? AI and robotics in terms of the exposures you're seeing on the right side of the page. And IT, often, folks are saying, maybe I'm getting my AI exposure simply by allocating to the IT sector. You can see that that's just about half of the portfolio, 50% of the portfolio in terms of sector breakdown. So we don't think sectors are the right way to think about this investment. It's really investing across sectors, across market caps, and this portfolio seeks to do that. And I think there's no better way to show you that in the final minute or two than showing you the attribution for 2025. So you can see the total fund return. Again, this is for our AI and robotics UCITS ETF for 2025, coming in at just about 40%. And importantly, a few things jump off the page to me. One is that if you look at the asymmetry of returns, the biggest attractor in the portfolio, stemming more from the robotic side with Iridium, detracted at around negative 1.5%, versus obviously the contribution side greatly outweighing that. And I'll talk a little bit more about the intra-year dynamics on the next page. But it's worth looking at also the contributors, right? Palantir, you mentioned it, Frank, as you're going through our six metrics. This was a name that returned 135%. And just close to 10% in contribution. But it's also a name where, like you said, from a valuation perspective, we trim the name considerably, despite it being the poster child for AI platforms. So we took the name from a 10% weight or 9.6% weight at the beginning of the year to just about an 8% weight on average, down to 6.9% at the end of the year. And the other thing that jumps off the page to me from an attribution perspective is within the top 10, there's not an over reliance on the mega cap names. So you'll see, NVIDIA, despite it being in the fund, is not driving performance, which is a differentiating point relative to both peers and probably relative to client portfolios. And B, it's not a single point in the AI value chain that's driving that value. Again, you're seeing robotics exposure, you're seeing hardware with AMD, you're seeing AI platforms with Palantir. So again, a mixed exposure. And then the areas where we've been underweight, software as a service, that's been the area of detraction. But again, if you look at the beginning weights, not just the end weights, but the beginning weights, we started the year at call it from 1 to 2%. So we already had relatively lower conviction in that space. And again, hopefully this just is a quick way to paint the picture. I'm cognizant we're at the hour. I'll put this slide up here to show you that simply, it's not just us being differentiated relative to the indices with our high active share, 75% roughly for this fund, 80s and even 90s for other funds that we manage, but also relative to peers. And despite us being hyper focused by the nature of our strategy to AI and robotics, and going through an AI bubble concern right in November in terms of market sentiment, we still finished the year, very strongly. And in the quarter, ARKI only gave up 3%. So in a volatile quarter, it shows stability despite having a targeted exposure. Being at the hour, I wanted to save that one question. And so for those willing to spend an extra minute or two, employment, Frank, you mentioned it, and I think we should address it, right? Should folks be terrified in terms of AI taking their jobs, financial services, knowledge workers, more broadly? Kind of how are you thinking about employment over the coming years?
Yeah, I mean, I'll give our outlook, which is positive. But first, I'll say if you're not using AI and finding ways to make it useful in your daily life, whether it's at home or at work, then maybe you should be scared. But I think generally, all kidding aside, we look at historical context as much as possible to frame our go forward research and investment decisions. And throughout history, technology has been a net job creator, which is why we have a larger population employed now than we have had at almost any point in history. And if you look at waves of significant technological advancement, like the early 1900s, for example, which we think is the last time we saw this much innovation unfolding at once with the internal combustion engine, the telephone, and electricity, you saw an interesting dynamic. You had productivity growth, so GDP accelerated and GDP per capita grew. Yet at the same time, you saw a reduction in working hours. So Henry Ford popularized the 5-day work week, where he dropped Ford from 6 days to 7 days, but kept everybody's pay the same because, in part, one, he wanted to increase employee morale and productivity and motivation. But two, they had advancements in manufacturing that could enable them to do that. Um, and that is what we think is actually the more likely scenario, where you could see us being more productive each as AI increases the leverage on each individual that's in the workforce. And yet we can see an accelerated period of reduction in average working hours, which has been a consistent trend through history. If you go back to the days of subsistence farming, we went from 7 days to 6 days to, in the 1920s, down to 5 days. It's not infeasible to us that we could see a reduction of 4.5 or 5 days in the age of AI. And I think, to put in context relative to some of the fear mongering, which I think he's right on so many things, but Dario Amodei, the CEO of Anthropic, partially because he's trying to trigger a productive response from the market, is suggesting in the past that we could see 20% unemployment in the next 5 years. Or more recently at Davos, he said we could see a 10% reduction in workforce. I think it's much more likely we see a 10% reduction in working hours than a 10% reduction in workforce, which is, again, the same amount of hours worked. It's just the much more optimistic framing and less alarmist that I think is more congruent with history, and is what we base kind of these different adoption scenarios of AI on. And I'm even maybe it was just an offhand comment where he gave a different number, but I'm optimistic that he shifted from 20% to 10%. and our mid case scenario is an 8% reduction in working hours. So now I feel like we're relatively aligned, just different halves of the equation that we're changing. Net, we're quite positive that AI will be a job creator, even though there will be shifting in the labor force and retraining required along the way.
Well, we are 65 minutes in, and I feel like we're just scratching the surface. Fantastic comments, Frank. Thank you very, very much for your time, and thank you for everyone who dialed in live and or who watched this in terms of recording. I will say, Big Ideas 2026, like we said, just came out. We really showed you a few sections, but there's much more, especially from the robotics and autonomous logistics, robo-taxi. So would encourage everyone to go download that, take a read, digest it, and reach out with any questions, as well as any questions relating to our strategies and our funds. We are more than happy to engage. So thank you again. And I'm sure 2026 will be a very dynamic and fascinating year to watch, and we will be there right with you. So thank you again.